What is going on, everyone? So my name is Bo Crable. In this video, I want to show you something that I believe is really one of the best and simplest ways for somebody to make some money pretty quickly. Now, this is not a get-rich-quick scheme, but if you want to make a little bit of money quickly and not a lot of time, this is the move. So this is an options trading strategy called spreads, specifically credit spreads. So if you're not familiar with options trading, it's okay. Just hold on for a second. It's going to start to make sense. However, a very popular strategy to make money, specifically in regards to collecting income and collecting cash, is the wheel strategy. Now, the wheel strategy involves selling cash secured puts and selling covered calls. Now, the issue with this, and this is why I think, like, if you want to get some date money, like you want to go take, your significant other out to a date this weekend, like on Friday or something like that, or if you want to take your family out for movie theaters or whatever, maybe you need 50, 100 bucks, like this is a pretty cool way to do it. And you're not risking much, you're risking money, but not a crazy amount, and odds are in your favor. But anyhow, so with the wheel strategy, cash secured put, cover call, that actually requires a lot of money. If you want to do a cover call on a stock that's $200, you're going to be looking at $20,000 to have to, put up for collateral for that stock. And for a cash secured put, if you sell cash secured put at 150 strike, you need $15,000 to do that. And that's a lot. With short put spreads and short call spreads and credit spreads, and both of those, you're doing practically the same thing. So you're collecting almost the same amount of income, a little bit less, but you're at a fraction of the amount of collateral. Like instead of doing $15,000 of collateral, you're talking about like $150 or maybe $1,500. It just literally like a fraction, like usually like a tenth of the amount of collateral, while actually keeping the same slightly different odds of probability, and also you're dramatically reducing your risk. So this is why I believe it is the best way for somebody who wants to make a little bit of income. To what do you want to go do? You want to take your dog to the veterinarian this week to get his teeth brushed. You want to take your significant other to a nice Italian restaurant, or you want to take your family to the movie theater. I don't care what it is. This is a good way to do it. So let me just, instead of just going over this with you, let me just show you. So this is my software Option Scout, and this is free when I'm going to be showing you our option profit calculator, but you can go down to short put spread, and you'll see a little payoff chart here, right? So you can see we're going to be trading two options, okay? And it's similar with a short call spread. However, the difference is a short put spread is bullish and a short call spread is bearish. Now, why is it called a spread? It's because you're spreading, I don't even know the right term for that. I mean, you're spreading between a bullish and bearish. Well, what this really means is you're selling, you're not selling. You're selling one option and you're buying one option. For a short put spread is you're selling an option that is bullish and then you're buying a bearish option. For a short call spread is you're selling a bearish option and you are buying a bullish option. So you're spreading that, and practically what you're also doing is you're condensing your strategy. So you have a max risk, which you can see here, right here, and you have a max profit compared to, let's say, you do a cash secured put strategy, so cash secured put, or like a naked put, you're going all the way down. And same with naked call, you could have it all the way down. So, and again, the only difference between these is you're kind of spreading apart the strategies. Anyhow. So, but we're gonna go the short put spread. All right. For me, I like short put spreads for a credit spread better than a short call spread, just because I like being bullish on the market rather than bearish. And there's a lot of other advantages, in my opinion, as well, where this could get converted into a cash secured put. But anyway, you want to analyze that. So really with these credit spreads, all you need to do is you need to trade them once, like on a Monday, ideally on a Monday. And then you want to maybe check up on them once a day. Or if you don't want to at all, you can just check up on them on Friday, and either you can decide to let them expire completely worthless, both of them, or maybe you buy out one of them or buy out both of them. So I'll explain you throughout them, but it's going to be this simple, all right? So it may seem a little confusing right now, but once you do it, it's literally the best, simplest way, very quick way, not a get-rich-quick scheme, but a quick way to make some little cash. So let's do Microsoft, all right? Microsoft, it's a good stonk. It's one of the two stonks only that have a better credit rating than the United States government, which is very impressive. The other one is Johnson & Johnson, if you want to know. So this is how it would be set up, all right? So let's say we want to trade, all right? We're going to get ready to do this. We would select a option we're going to sell. Right also means sell, if you did not know. So right, let's go to, okay, it's right now it's at 234. So let's go to 15. So what we're going to do, we're actually going to collect $44 roughly in income, depending on the spread, because you can see the bid, ask, last, all that stuff. And then now what we do, that's a bullish bet right there. Okay, now what we need to do is we need to buy an option back. So let's do this one, 7. So now what we're doing, we're actually be paying like 9 cents or $9 or so. So we're gonna be collecting, 44 and paying 9 about. Okay, so let's look at this. So look at the collateral you're doing, $1,400 only. So that means you need $1,400 in your account. Now, be cautious with this to an extent. Like, don't be like, oh, okay, I have $20,000 in my account, so I'm gonna use up every single. So what I'm gonna do is I'm gonna do 10 of these strategies. Okay. The issue with that is that if you do start to lose, like you could lose a lot. That's an issue. Like, okay, you make $390, really high ROI. You still have a high probability of success. And like if Microsoft, now let me show you kind of how this pans out. All right. So what we're looking at here. Okay. So what we have here is we have a 215-200 spread. So what this means is you sell a put at 215 and you buy a put at 200. So look at this chart, okay? At this chart, you can see your break even is 240, and let's just put this down to 1. It's not going to affect any of the chart, but it's just easy numbers. So your break even is 214.61. What does that mean? That means as long as Microsoft stays above 214.61, you don't lose anything. Okay, and if Microsoft stays above 215, you can see here in this little green graph, you're making your max profit, which is $39. So you walk away with $39. You can take your significant other to a nice little date. I know inflation's up, so maybe that's not a nice fancy Italian restaurant, but maybe it's something cool. Okay, that's enough for the movies at least, right? Movies and popcorn. So you collect $39. That's you. That's in your whatever you want to do with it. You can withdraw that directly to your bank right away, no big deal. And this is all what you're putting up, $14.61. And this is on a weekly basis, okay? So this is a week option. This expires in 1 week. We could actually change this up and we could collect more, but the option expires later out. Let me show you that. So let's do that right now. So let's say we want to do the same type of spread, but we want to just collect a different expiration. Now when we do this, we're going to collect more income. Our ROI will be less. And you're going to notice another thing, your probability will be less as well. And the reason for that is because the odds of Microsoft going to 215, in a week from now is significantly lower than in 8 weeks from now. Okay, or 4 weeks from now. So let's do a 4-week one. So let's go 1, 2, 3, 4, and let's just do the same thing. All right, so we're going to buy at 200 and we're going to sell at 215. Okay. So you're going to see, so now instead of collecting $39, you're collecting $213. You actually have less collateral. The reason for that is because here's how the collateral, I can't speak clearly. This is how the calculation for this works. It's the difference between the strikes. So it's the spread, okay? I told you, you're spreading it. You're spreading the bullish and the bearish bets here. So it's going to be that. So that's $1,500 because 215 minus 200 is 15 times by 100 because it's options. That's 1,500. Then you need to subtract the amount you're collecting because you're getting this in cash. Okay, so and you'll notice that your collateral and your max loss is the same essentially. But now you can see your probability of profit went to 74%. Why is that? Well, it's because with more time goes on, it increases the odds of the stock going there. But now you're collecting $213 instead. So and that's still a really, really high return on investment. But anyhow, that's it. Now let me show you a short call spread. So now this would be if you're, let's say, bearish onto the market. Okay. Oh, also I forgot to show you this in what's it called? Option Scout. You can now pull up a trading view chart just by hitting stock data. So if you want to play around and see the Microsoft, actually let's see where is actually you can probably see this data here. What's the 52-week low? I think TradingView has this somewhere, right? 52-week low is 232. So yeah, that option would be trading is lower than the 52-week low significantly. But anyhow, let's go back which is the data. And let's do this for, let's do a different stock, right? Let's say, you know, you're, I don't know, let's say you hate Bitcoin. You just hate Bitcoin for whatever reason. Okay, so you go to CoinStock. It's a Bitcoin stock, essentially. Well, it's not exactly Bitcoin stock, but they make money from cryptocurrencies, okay? Well, let's say, you know, you hate Bitcoin. I don't know. So now you can, this would be a bearish bet, all right? Because now what you're doing is you're going to be selling the call. And let's go 2 weeks out. Pick whatever date you want. And you're like, you know what? I think this Bitcoin thing's going to be going down soon. So what you can do, let's say you select, I don't know, a 75 call. So what that means, that's what you're selling it at. And here, if you do this, you're going to have unlimited risk. After you look at the chart, you can see it just keeps going down, 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 down. But then you have your upside there, right? So now to cap your risk, let's buy an 80 call. So your collateral is going to be 500 minus one of the premium we're collecting. So yeah. Okay, great. So this is what it is. So Coinbase, October 21st is 2 weeks, 75-80 call. So this is a spread, all right? So your max profit's 109, your collateral is 391. That's not a lot. So look at that, $109 for only up putting 309 bucks or 390. Your probability is still pretty high. Now, if you want to increase that probability, what you would do is you would collect less income, and you would actually just push this 75 one. You would push it up, so you could push it up to 80, and then you push that the long one to 90, you know, or something like that. Whatever you want to do. But yeah, so that's how that would work. So these are credit spreads. You collect the cash, you can do whatever you want with it. Okay. Now again, just be cautious. Like this is a good thing, I think, as well, as if you have like a portfolio. Like let's say you have a long-term portfolio. You know, you have index funds, all these different things. This is a nice thing where you use a small amount of collateral and you make some extra income. You know, this is not really a smart thing to use all of your buying power. Like let's say you have a $10,000 account. It wouldn't make sense to go risk $10,000 of collateral like on one trade or even a couple trades. The reason for that is because if this trade does go wrong, right? Like if it hits here, you know, you're losing $91, which then you have to do $91 times what amount you're doing it. So it's not like your odds are like 100%, right? Like so that could still happen, because this happens. Your max loss happens if Coinbase hits here or higher on that situation. So if you're wrong about the Bitcoins, then you could be in a lot of loss. So anyhow, but that's about it. If you like this video, hit subscribe, hit the like button, comment down below. Check out my website, Option Scout, if you want to visualize your options trading profits. If you want to see more videos like this, just watch my other videos. I have more about options trading. Okay, see you in the next one.